I recently invited Justin Ishbia to come on the podcast. Justin is the co-founder and managing partner of Shore Capital Partners, one of the most successful lower middle market private equity firms in the United States. And Justin was kind enough to reply and said he'd already done a few podcasts in 2025, but asked me to check back in early 2026. And rather than letting the conversation end there, I decided to use the time to study his work more deeply. So I spent time digging into Justin's background, the early days of Shore Capital Partners, and most importantly, how they've been able to generate a median return of roughly 5.5 times by buying companies with enterprise value in the 1 to 10 million range and executing a disciplined roll-up strategy. Much of this research comes from Justin's long-form interviews on Invest Like the Best with Patrick O'Shaughnessy and 20VC with Harry Stebbings and Shore Capital Partners website. And there on those podcasts, he goes deep on incentives, systems, and how Shore actually operates under the hood. What follows is my synthesis of those conversations, combined with additional research on, again, Justin Ishbia and their playbook and the systems they've built to compound capital at a level very few firms have been able to sustain. A bit of context first. Justin comes from a family deeply embedded in finance and business. His brother, Matt Ishbia, is the CEO of UWM Holdings and the majority owner of the Phoenix Suns NBA club. Justin, meanwhile, built his career in private equity, applying that same long-term, disciplined mindset to acquiring and scaling small operating businesses. Shore Capital Partners was founded in 2009 and is headquartered in Chicago. From day one, the firm was built around a very simple idea that's incredibly hard to execute at scale, which is buy small businesses in fragmented markets, professionalize operations, roll them up through add-on acquisitions, and ultimately sell the scaled platform to a larger buyer. This is why Justin Ishbia really matters, because Shore has built an unusually strong and durable track record. The numbers associated with the model are the kind you almost never see sustained over time for long term, which is 83 platform investments, over 15 exits, and reported historical outcomes like 7x average cash-on-cash returns and roughly 72% IRR, with no realized deal below 3x and the median outcome around 5.5 times. At the same time, Justin is candid about the limits of performance. He said openly that you can't assume results like this will continue forever, especially as a firm keeps growing. But the fact that they've already done it at the scale is exactly why the playbook is worth studying. And that's what we're going to do today. And a big part of that playbook comes from knowing who to copy. Justin has reportedly cited Constellation Software and Mark Leonard as major influences. He has a line that captures his approach perfectly. I'm not smart, I just know who to copy. Constellation did it in software. Shore applied a similar discipline to operating businesses, particularly healthcare services, where fragmentation is high and scale creates real advantages. And that mindset tracks back even further to the lessons from his dad. The biggest takeaway growing up was simple: don't do things you don't understand. His father worked in insurance and stayed relentlessly focused on what he knew. He started in essentially one town, and when a crisis hit, his deep understanding of a single vertical allowed him to expand nationwide. The broader idea is powerful because when you understand one product and one niche extremely well, you can scale it much further than most people expect. Perfect example what Justin has done with Shore Capital, buying those 1 to 10 million enterprise value companies and building a huge firm around this thesis. Another theme Justin comes back to often is health. He's very open about the fact that without health, nothing else matters. He's proactive about testing and checkups, and he acknowledges the role of both luck and genetics because his grandfather died of a heart attack at 56, and Justin is particularly focused on heart health. He said his most important job is to be there for his kids, not just now, but when they're 40, 50, and beyond. So now a little bit about the early days and to really understand how Shore got started. Justin was 31 and his three partners, Rob Shore, Adam Böhler, and the third early partner, they were 28, 27, and 29, and only one of them was married. He described the early work ethic as unreal. Most nights in the office until 7, 8, 9, even 10 p.m. Leaving at 4 p.m. simply didn't happen. He believes this intensity created a massive early advantage. With fewer personal constraints, they were able to outwork competitors and build momentum before others could keep up. And this brings us to Justin's view on luck. He believes in luck, but only as a function of repetition. You get lucky when you do something hundreds or thousands of times. He shares a story where Shore landed an exceptional industry leader with one well-timed call. To outsiders, it really looked like luck. In reality, the partner making that call had spent 18 months learning the industry, building relationships, attending events, and really showing up consistently. The moment looked super random, but it was earned. Justin's framing comes down to one simple question. How do you increase the odds of success? By doing the right things repeatedly and not giving up. That philosophy showed up early because Shore's first deal was a 6 million acquisition, and just 3 years later, it sold for 50 million. That single outcome gave them the credibility to raise their first institutional fund. And from there, industry selection became non-negotiable. Justin is relentless on this point. Pick an industry with long-term tailwinds. If you do that, results rely less on luck and more on discipline. He often references the Buffett and Munger idea where when a great management team meets a bad industry, the industry wins. Even elite operators struggle in structurally declined markets. Industry choice sets the ceiling. One of the most interesting parts of Shore model is how they think about margin of safety. In many private equity deals, committing $100 to a thesis means investing $60 to $80 into the platform and reserving $20 to $40 for add-ons. Shore often flips that. They might deploy just $5 to $25 into the platform and reserve the majority for add-ons. The benefit is enormous. If the first deal isn't perfect, it isn't fatal. There are multiple paths to success, and they frame it like this. If they get one or two things right, they can still make 3x returns. If they get 4 or 5 right, they will make 5 to 7x. And all this doesn't come without mistakes. And mistakes, in Justin's view, are unavoidable. If you're playing at high level and you're never failing, you're probably not pushing hard enough. And the key is simple. Make mistakes, but don't make mistakes that kill you. Shore hasn't had an outcome below 3x yet, but Justin openly acknowledges that eventually that day will come. Before moving on, it's worth briefly pausing on something related. If this research on Justin Ishbia and Shore Capital resonates with you, especially the idea of buying small, overlooked businesses and compounding throughout disciplined execution, you should know about CapitalBad, today's sponsor. And they're a platform built specifically for investors who want to back acquisition entrepreneurs, the next generation of operators buying real businesses in unsexy, fragmented markets. This isn't venture capital. There is no hype, no moonshots, and no public market noise. Instead, you'll find serious operators sourcing profitable businesses, sharing vetted deals, clean data rooms, and realistic timelines. Very much in the spirit of how Shore built its early platform. If you believe in backing builders instead of startups, CapitalBad is where that actually happens. Head to capitalbad.com. That's capitalbad.com. I'll also put the link in the show notes. But now coming back to the Shore model, Justin also talks about where small players win. They focus on smaller cities and localized markets where being on the ground matters. The strategy is consistent. Buy a platform, execute add-ons, consolidate the market, and sell the scaled business to a larger buyer. One of their simplest diligence tools reflects that local mindset. Before acquiring a healthcare practice, they'll call 5 to 10 local operators and they simply ask, if your mother needed this procedure and couldn't come to you, who would she go to? Repeat that enough times and the best operators reveal themselves. The market will just give you the answer. Another major evolution in Justin's thinking has been around leadership. Sure now prefers young, hungry, first-time CEOs, and roughly 80% of their CEOs fall into that category. They'll make mistakes, but they're not left alone. Sure builds a board of around 7 people around them to compress learning curves. And Justin said that a lot of people have been making jokes on them that there are more board members than there are millions in revenue. But Justin believes a smart person can learn 90% of an industry in 18 months. The final 10% takes so much longer unless you surround them with the right people. And the CEO has 3 jobs. Set vision and strategy, number 1. Recruit and retain talent. And hold people accountable. Sure recruits industry veterans, often 55 to 75 years old, who are semi-retired but still want to contribute. Justin calls it failed retirement. They understand customers, pitfalls, and second-order effects. Compensation is usually equity-based, not cash, while creating strong alignment with minimal time commitment. They have to meet like 4 times per year. Justin shared some data that those board members can make up to 250,000, if not more, if it's a successful project. So ultimately, Justin says he doesn't promise outcomes, he promises the system. And in his view, that system works 8 or 9 times out of 10. He also pushes back on the idea that private equity is just finance. He says he's really in psychology and sales. It's a hustle business, and too many young people want success too fast. His advice is very straightforward. Buy one good business, then buy another one. Make sure they work, and then go raise a fund. And the system is the star. So that's the research on Justin Ishbia and Shore Capital Partners, a firm that has completed hundreds of acquisitions focused on 1 to 10 million enterprise value and built a system that has produced exceptional outcomes over time. If you enjoyed, share it with a friend, with a partner. But now, thanks again for listening, and I'll see you in the next one very soon.